Going to my next guest, we're joined by Paul Ashworth from Cameron Harrison to talk investment views in the current market environment. Welcome back to the show, Paul.
Thank you.
We've got a really big week of data. We just went through it there, and I wanted to talk first about the chart that you did provide me because I absolutely loved it, which was talking about debt burdens in Australia. And the theme that you've got there is that we sort of need to hold our horses a little bit when it comes to this interest rate story.
Yeah, that's right. And I think the Australian situation, as opposed to the US households situation, provides that potential contrast between what the Reserve Bank might do and, of course, what the Federal Reserve might do. But firstly, in terms of Australia and the Reserve Bank, we do think that bond markets have over aggressively priced on futures increases in the cash rate, and it will give cause for a portion. At a 1.25%, 1.5% cash rate, that really has the potential to destroy 1.6 to 1.7 trillion dollars of household value. So we think markets in Australia, as with worldwide, will pause as we have a reversal of this wealth effect, which has been very strong over the last 2 years through COVID, but in reality has been very strong over the last 30 years.
So do you think that puts the Australian economy, or at least Australian households, in somewhat of a precarious position as interest rates rise? I mean, how considerable is the risk here? Or is it just going to be the fact that because of that high debt burden, eventually we're going to get this kind of self-limiting situation where growth slows, RBA stops raising rates, and we sort of reach a, quote-unquote equilibrium?
Well, I think that's a scenario that markets having aggressively reacted over the last 2 months or so. I think markets are exactly contemplating that situation for next year. Maybe not that it's gets to a self-equilibrium. But I do think it does get to a significant cause for pause by policy, because whilst the implied percentage of household decline that would imply around 15% in itself is something that's capable of being absorbed. The actual wealth effect, given the significant rise in household or house prices. Just this, the mere saying of 1.6, 1.8 trillion dollars, that certainly does, weigh on wealth effect, and the abilities of and the confidence of households to spend going forward, and of course employment.
Turning stateside as well, because I note your second point here that you've popped through to us, that US economic growth is to be lower, but recession, question mark. Do you think that the expectations of a major slowdown in US economic growth is a little overdone as well, or what's your view on the growth outlook in the United States?
We're as with most stateside analysts at the moment, we're modestly positive on earnings growth. Of course, we've got to differentiate what it is that we're investing in, which is business, industrial and services businesses, with high levels of profitability and low levels of debt. That's to be differentiated, from what's causing carnage at the moment, which is tech companies and tech companies that have had high valuations and no profits. But of those well operating businesses, the earnings environments is okay. Difficult, obviously, in terms of the supply side, in terms of input costs, but they are getting price increases in the US, which is to be differentiated in other jurisdictions. it's proving a lot more difficult, for example, in the UK for businesses, to get those price increases through, but they're getting significant wages increases.
So would it be fair to characterise this then, just on that, as something of a mid-cycle slowdown rather than a major contraction, potentially prolonged bear market? I mean, do you have kind of a view on that possible binary?
Yeah, and that's really where we're at this point in time, is just to have that pause. If we go back 8 months ago, markets were very laissez-faire and blasé in terms of interest rate pricing. It's fair to say that they've gone to the extreme, as your chart of the day illustrated there. So there is reason for cause for caution. We're always minded that recessions, in significant recessions, are credit-led, credit crunch-led recessions. And just at this point in time, we just can't see that in the US. Those well-run industrial services businesses, they've taken the opportunity over the last 2 years, to get their balance sheets in order. They've issued good long-term cheap debt. Households, as the chart of the day illustrates, households have got themselves into a pretty solid position, in contrast to Australian households. In Australia, post GFC and through COVID, when the going gets tough, we just go and borrow more. That's not in the case in the US. They have consolidated. So, when we put those two things together, yes, certainly confidence has been hit, but we don't see recession as being the primary call, certainly over the course of the next 12 months. However, we do think that longer term interest rates, through 2023, 2024, they do get to a significantly higher point.
Well, I did want to ask about that. Sorry for interrupting, Paul. I do apologise. Sure. I did want to ask that because we're almost running out of time, and I'd love to speak longer. But you did make mention here in your note about longer-term interest rates being something that will come about and that market participants will have to stomach. Also, you add there just something that I haven't heard too much about, which is around defence spending. Can you just quickly explain that to us, and again, the effect on long-term rates?
Sure. So, we've had the benefit, over the course of the last 30 years of declining bond rates. We've also had the benefit that we've seen trade, international trade, operate well. Very few frictions to it. Geo-economic political risks have been low. That's clearly looking different. Certainly over the course of the next 5 to 10 years. And we are going to see, I think, government spending significant amounts of money on defence, together with the other things that they need to spend on in terms of ageing population, healthcare, social security. So it's those items together with significant, an extra 1.5% of GDP. On average, flowing through in terms of government spending, and probably most likely deficit spending, that will put or will be a key factor for higher, longer-term interest rates.